Hi there, and welcome to yet another edition of the Efficient Proud Clients podcast series. My name is Renier van Zyl, I'm a portfolio manager, and for the next 2 weeks, me and my colleague, Karl Pape, will unpack the differences between passive and active investment management. Now, as most of us already know, passive investment management entails the selection of instruments that closely track or resemble benchmarks or an index such as the S&P 500 or the FTSE 100, for example, at a little bit of a lower fee. Those instruments are also catered towards market participants that believe that the markets are more efficient. And over the last several years, there's been large players that has come into this space with the necessary products, such as BlackRock and Vanguard. Now, there are also some drawbacks towards passive investment management. We know that investors can choose the wrong markets that might not perform for a very long period of time. We saw this in the US markets, where markets were flat between 2000 and 2010, and then also more recently Japanese markets, where the Topix 100 has moved sideways for the last 30 years. At Efficient Proud Clients, we deploy an active investment strategy where we actively select instruments and securities which we believe will outperform the market over long periods of time. So in the first episode of this podcast series, we will have a look at real-world examples where we've been able to extract value for our clients out of the market, and we will look at more specifically 2022, which was a very tough year for global investors. Then in the second episode of this mini-series, we will look at the intricacies surrounding passive investment management, but more specifically the pros and the cons. And we'll also look at how do we use those instruments in our own solutions, and how can investors gain access towards those solutions, obviously within the realm of the advice which was given to you by your financial advisors. So myself and Karl are very much looking forward to this conversation. We hope that you can join us, and we trust that you will find it insightful as always. Thank you very much.